global stock and bond markets are mostly steady ahead of Fed testimony and non-farm payrolls data later this week. Gold lurched to a new record high of around $2,100 an ounce overnight. And in China, all eyes are on the National People's Congress for a new GDP growth target. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ senior strategist in China, Zhaopeng Xing, highlights the role climate policy will play in this week's National People's Congress.
It's very likely that the China will set the energy consumption, the overall energy consumption by the economy to increase at a 0 growth rate this year and the next year. I think it will be a big constraint to economic growth.
But first, in 5 and 5 with ANZ, markets were generally steady overnight, ahead of Fed Chair Jerome Powell testifying to Congress on Wednesday and Thursday. And then there's non-farm payrolls data on Friday night. Powell is expected to remain in hawk mode. Later today, China is set to announce its new GDP growth target for 2024. Against this backdrop, the S&P 500 was flat overnight. At 4 a.m. Sydney-Melbourne time, it was at 5,133. Now, of note, Japan's Nikkei index was up 0.45% last night and closed over 40,000 for the first time because of rallies in AI-linked stocks. But it's the gold price that stars this morning. It was in touching distance of its record high, sitting up 1.5%, just over $2,100 an ounce, because traders are increasing their bets the Fed will cut rates from June. The Australian dollar was trading down 0.1% at 65.17 US cents at 4 a.m. Sydney-Melbourne time, while the Kiwi was down 0.17% at 60.98 US cents. Number 2, continued weakness in Australia's housing sector shows construction activity is failing to keep up with record population growth. That's according to ANZ senior economist Adelaide Timbrell, talking after building approvals fell 1% in January, when a 4% rise was expected. Adelaide says there is scope for a turnaround in 2024.
What we've seen is that recruitment difficulty is easing in the construction sector, so a little bit easier to find workers. We're also seeing that materials prices, while they're not necessarily getting cheaper, they're certainly not rising in price as much as they were in 2022. They're calming down. That's going to give particularly developers of larger collections of homes some certainty around their costs. And then with funding costs not likely to rise from here, we also see a little bit of certainty on that side.
Number 3, Australia's fourth quarter GDP figures could be weaker than current expectations as the final pieces of the puzzle come in ahead of Wednesday's release. ANZ senior economist Blair Chapman says business indicators suggest downside risk to ANZ's forecast for a 0.3% rise in the December quarter and 1.5% for the year.
Company profits actually came in stronger than expected at 7.4% quarter-on-quarter. We were only expecting 1.8% quarter-on-quarter, while the market was expecting 1.1%. But when we look at real inventories, they actually declined 1.7%, which is much greater than we or the market were expecting. And then wages and salaries are also a bit weaker than everyone was expecting at 0.9 quarter-on-quarter.
Number 4, Australia's ANZ job ads series fell 2.8% in February, resuming a downward trend seen through 2023. ANZ economist Maddie Dunk says the fall means there's scope for unemployment to rise further, although businesses might first cut hours for existing staff rather than just cut jobs.
Businesses are being quite cautious. They're preferring to hang on to their staff. And because of that, we do think that the near-term adjustment in the labour market is likely to play out through a decline in hours worked rather than a decline in employment. So in other words, businesses might reduce the number of hours that they ask staff to work, but they'll keep those staff on the books.
Number 5, GDP data due in South Korea later today is expected to show 0.6% growth in the December quarter and 2.2% from the same quarter a year ago. ANZ economist Crystal Tan sees growth improving in 2024, thanks to strength in semiconductor sales.
The recent high-frequency data have been quite encouraging. The inventory-to-shipment ratio does point to improving supply-demand dynamics. And also, semiconductor export revenues are actually up more than 60% year-on-year in the first 2 months this year.
Crystal tan there. Now, in our deep dive interview, ANZ China Senior Strategist Zhaopeng Xing explains the importance of a decision likely to come out of this week's National People's Congress to reduce per capita energy consumption.
In the past 3 years, China has made a very little achievement in the emission areas. In the 14th Five-Year Plan, China set very aggressive climate targets to cut the energy consumption per unit GDP by 13.5% and carbon emission by 18% as of 2025. Now, only 2 years left. At this moment, I think the per capita energy consumption only dropped 2.4%. Per capita carbon emission only dropped by 4.6%. Yeah, it's the number remain very far from the targets. I think this year and also the next year, we will see very aggressive climate policy in China. It's very likely that the China will set the energy consumption, the overall energy consumption by the economy to increase at zero growth rate this year and the next year. I think it will be a big constraint to economic growth. In order to achieve the climate target set in the 14th Five-Year Plan, I think China will keep the GDP growth rate positive and zero increase in the energy consumption. So this will be a big challenge to the economy. I don't think it's not achievable because China has good experience in the past to make every effort to achieve the targets set in the Five-Year Plan. This time, we expect the government will try the best to complete the targets, so that we expect the climate target will be a big constraint to growth in this year and the next year. This is also a big reason why we expect the China government will downgrade the GDP target for this year.
And what sort of things will the government and businesses and consumers in the economy be asked to do to reduce per capita energy consumption?
Basically, I think there are two solutions. One solution is to encourage people to use more green power because the green electricity is excluded from the energy consumption per capita calculation. Another solution, I think, is to save energy at the best because in the past 3 years, we saw a big increase in energy consumption by households, so that we expect China will encourage households to save energy this year. Last week, China issued a policy to encourage people to trade in their old consumption goods, their old home appliance with a new one that can save energy. I think this is the right thing to do this year because it can also provide a solution to the overcapacity in the economy. China economy has many oversupplies in broad sectors, in the home appliance sector and also the green product, the green sectors. There are some overcapacities in the economy. I think the trade-in policy will help these sectors to offload the inventory, and it will also benefit the economic growth this year.
Zhaopeng Xing there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, March the 5th. Catch you tomorrow with a preview of Australia's GDP figures. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.